Excuse me, Professor Seaman. I think you're muted right now.
Can you hear me now?
Yes, we can.
Okay, sorry about that. Really sorry about that, guys. So the first 4 minutes are going to be a waste. All right. So let's go back to the changes I made on the module. So what I showed you was the class module, and why I show you why I'm showing you this is number one, I created a video that demonstrates the entire closing process. You're going to want to watch that before you do the homework. I've also uploaded all the handouts from today with the answers. And I've also, of course, added some homework. I know you guys don't like homework, but it's needed. So you're going to want to watch this video. It's about 34 to 40 minutes. It's not too bad. It pretty much explains everything that you need to know about closing. Okay, so today we're going to go over chapter 4 still, accrual accounting concepts. So the chat is open just in case. Okay. And the most important thing today is going to be explain the reasons for adjusting journal entries. The adjusted trial balance I'm going to talk about a little bit, but that's just like preparing an unadjusted trial balance. So what you're doing is you've got an unadjusted trial balance. Then you prepare these adjustments to make the financial statements ready to be prepared to prepare the financial statements for. So the adjusted trial balance is making sure everything is accurate, and you're now ready to prepare the financial statements, which is where we're going to go next. And the closing process, again, I made that video because it's easier to understand via video than to explain it to you. And I think that video explains everything. So I'm not really going to hammer those. The main thing I'm going to hammer today is the reasons for adjusting journal entries. Okay, so the first reason adjusting entries are needed, under the accrual-based accounting, transactions recorded in the period in which the events occur, but may affect other periods. So for example, I may have a transaction that happened in January, but that transaction in January could affect February, March, April, May. And as we said in the periodic principle that every period is its own set self-contained unit, I have to record the effects of the transaction in January, the effects of the transaction on February, the effects of the transaction in March, even though I only recorded the one transaction in January. So one reason we do it is because of the periodic principle, saying that all periods, months, quarters, and years have to be their self-contained unit. So this simply means that adjusting entries are used to make transactions affect the correct period. The need for adjusting entries. So here's an example. Let's say ABC Machine Company builds specialized machines. As part of ABC Machine Company's policy, they require that customers provide a deposit in cash of 10% of the total invoice price. So that's one of their sales policies. On January 1st, 2020, James Corporation, a customer of ABC, contracts with ABC to purchase a machine that will cost $50,000. So according to ABC Machine Company's policy, James has to send a 10% deposit of the total cost of the machine. So if the machine costs $50,000, James first has to send ABC 10% or $5,000. So let's just say that they did that on January 1st. So the whole deal was wrapped up on January 1st. So for example, let's say ABC builds specialized machines. As part of the machine sales policy, they require the customer to provide a deposit and payment of 10%. On January 1st, 2020, the customer orders a machine and they send the money. Now a transaction has happened in January between ABC and James. James has given ABC $5,000, and ABC in turn has promised to build and sell a machine to James. So remember, every time a company is involved in a transaction, a journal entry has to be recorded. So in January, I'm gonna debit cash for $5,000 and credit customer deposit for $5,000. The reason it's customer deposit and not revenue is because I haven't done anything yet to satisfy my customer James. Remember, under the revenue recognition principles, I have to satisfy them in order to recognize revenue. So I can't recognize the revenue. In this case, it's a liability because if I decide not to sell the machine to James, or I can't sell the machine to James, I have to give James money back. And we said that an amount owed to an outside party is a liability. James would be an outside party. I would owe them $5,000 if I decide not to build their machine or can't build their machine. So that's a liability. So as I said, on January 1st, when I receive the money, I'm going to make this journal entry because I have a valid transaction, and every transaction that's a valid transaction has to be recorded in the general ledger. Again, remember that ABC Machine cannot record the deposit as revenue because it has not built and delivered the machine to James yet. ABC has not met the specific performance obligations of the contract between ABC and James. In other words, ABC has not satisfied its customer James yet. Any way you want to think about that, that's the basic concept. So the account customer deposit is a liability because ABC is obligated to give the $5,000 back if it does not meet James' specific performance obligation, which is to build and sell a machine. Everybody okay with that?
Yes.
That's pretty simple, or getting a little complex, or what? Remember, this all happened in January. So a transaction happened in January. Also remember, according to the periodicity principle, the life of a business is going to be broken down in artificial periods such as month, quarter, or year. Remember again, this all happened in January. And then we move to April. Remember, April is a self-contained unit, self-contained month. So let's say that ABC completes the construction of the machine it is going to sell to James on April 1st. ABC ships the machine to James on April 2nd and also sends an invoice for the entire machine price of $50,000. Now remember, we made this journal entry in January. We made this journal entry in January. And also James sent a deposit check. So on April 2nd, when ABC has satisfied all the performance obligations of its contract with James, it may now recognize the revenue because it did all the performance, it met all the performance obligations. It may now recognize the revenue from selling the machine to James. So in accordance with the revenue recognition principle, ABC records the following transaction. Well, this was the transaction that they recorded in January. So what they have to do is now they get to recognize the revenue, including the amount that was paid by James in the deposit in January. So again, I'm putting this up here just to remind you about the journal entry that they made in January. So in April, I can record $50,000 worth of revenue because that's what I charged James, and that's what they agreed to pay once I deliver the machine to them. So I get to recognize all that in revenue. However, the customer deposit is now mine to keep. It's not a liability anymore. Since I've honored the contract and met all the requirements of James, that money is now mine. So it's not a liability anymore. So I debit customer deposits. Remember, all liabilities are on the right side of the accounting equation. And when I increased it, I credited it. So when I decreased it, I debit it. And then James still has $45,000 in which they need to pay me. They owe me 50, they paid 5, so they owe me 45. So I'm going to send them a bill and they're going to hopefully pay me. So on April 2nd, 2020, when ABC has satisfied the performance obligations of his contract with James, it may now recognize the revenue from selling the machine. So in accordance with the revenue principle, ABC records the following transaction. Remember that since James has already paid $5,000 toward the price of the machine, it only owes ABC $45,000, which is represented by this. Does that make sense? So this is the whole thing in a nutshell. Remember, this journal entry was done in January, so it was self-contained in January. A related but separate transaction happened in April, and it was recorded this way. But they are related. One was a deposit and one is the completion of the order. And here's the journal entry one more time. So now I'm going to give you an exercise, exercise 1, to complete yourself for a couple of minutes. If you don't have it with you, I'm going to show it on here, and then I'll show the answer. What do you think? Just in your mind, try to write down the journal entry on a piece of paper, or just do it in your mind or whatever, what you think the journal entry is going to be. Or if there is a journal entry. Just remember, Smith has not provided the services yet. So they have not satisfied the performance obligations. All right, I know I'm going a little fast, but you can look at it. So here's the answer. Debit cash for 25 grand. 25 grand is simply the amounts in this customer deposit column. You add all that up, it's 25,000. And again, we're creating a liability. Can everybody see this?
Yes.
And again, we're creating a liability because if I don't satisfy the order, I don't satisfy my customer, I got to pay them their money back. Remember that the Smith Guide Service has not done anything to earn the revenue on January 31st. All it did was collect the money. So according to the revenue recognition principle, the 5 steps, it cannot recognize revenue on the amount its customer ever paid because the customer has not been satisfied yet. Also remember that Smith is going to have a liability defined as the amount that the entity owes the outside party, an obligation to give each customer his or her money back if they fail to provide the service. The amount of the cash Smith has collected before it provided service is a liability until the service is paid. All right, let's try number 2 now. Do you see that?
No.
Do you see it now?
No.
No? Do you see it now?
Yes.
Okay, so try this one on your own. All right, let me pull up the answer. And if you have any questions, please ask. Or you can just hit me with the chat. That's the small screen. Okay, so that's the journal entry. And the reasoning, since Smith has satisfied his obligation to his customers by providing the guide service they requested, Smith would stop having an obligation to pay the money back to the customer if Smith did not provide the services. So basically now I don't owe the money back to the customers because I provided the services that they wanted. So Smith does not have an obligation to pay the customers back. The liability is reduced by debiting the liability account customer deposits. Also, since Smith has provided the service and therefore satisfied its customers' performance obligation, it has now earned revenue equal to the amounts that it billed each customer it charged each customer for the service. Since customers have already paid $25,000 for the services, the amount of customer deposits, the total amount of services provided was $28,000, and Smith will need to send its customers a bill for the $3,000 remaining. Let's try class exercise 3. Well, this is the expense side, sorry. The same thing is true on the expense side. Remember, the matching principle says we have to match the revenues with expenses. So an expense could be in 1 month, let's say January, but it could affect many months or just one other month, say mid-February, March, or April. So here's an example of that. So the same thing is true on the expense side. For example, let's say that Flint Company signed a contract with Smith Insurance on January 1st, 2020. Where Smith Insurance will provide insurance coverage to Flint for 1 year. The total premium insurance policy cost is $24,000 for the year 1. Flint paid the entire premium on January 1st. Since Flint has not received any insurance coverage, remember the policy covers January 1st through December 31st. Today is January 1st. It would be called a prepaid expense. I prepaid it. But it is a transaction because I gave Joe Smith Insurance $24,000, and in return, they promised to provide me with insurance coverage. So let's say the Flint company ever, so it's $24,000 for 1 year. So that would be $2,000 a month. The way I got this $2,000 is dividing 24,000, 24,000 by 12 months. So now part of it is not prepaid anymore. Part of it is used up. Month of January is used up. 1/12 of it is used up. All right, let's try exercise 3. Let's say, okay, so try one on the expense side of it. Remember, again, each period is a self-contained month. All right, here's the answer. So remember, it's 12,000 because I only paid half of it. Little trick in there. See if you were reading. Since Davis provided Jones with a down payment on the insurance policy of 1/2, $12,000, but has not received any insurance coverage, the amount of the down payment is an asset, a resource owned and used by the entity until it's used up. One more then. So what adjusting entry would Davis make in its general ledger on, what adjusting, yeah, would it make on January 31st after 1 month's worth of insurance coverage? So on January 21st, the insurance policy purchased on December 31st from Jones has now covered Davis for 1 month. Since the insurance policy covers 24 months and the total cost of the premium is 24,000, we said that each month of policy coverage costs Davis $1,000. So on January 31st, 2021, Davis has used 1/24 of the policy. The second reason adjusting entries are needed is simply because people make mistakes. Okay, there are bookkeeping errors, you'll make errors, your coworkers will make errors, and those errors need to be fixed before to make sure that the financial statements are accurate. So you need to go through the general ledger and make sure that all the accounts are correct. In accounting, we refer to that as cleaning up the general ledger. And when a general ledger is clean, we say that it is so clean you can eat off it. That means that everything is correct and all the accounts are where they are the correct amount. But there's an understanding that people would make errors. You have clerks entering numbers and they make a mistake. You have other people entering numbers that they make mistakes. You make mistakes as the accountant. And these all have to be cleaned up before you can publish your financial statements. The third reason adjustments are needed and adjusting entries are needed, sometimes revenue is earned, performance obligations of the customers are satisfied, but for whatever reason, the company has not or cannot record the revenue timely. For example, the actual amount of the revenue is unknown. Maybe the customer has not been sent an invoice. And again, simply mistakes have been made. For example, you may have an engineer who you bill out who is notorious for not sending in their billing, the clients that they worked on information so that they can be billed. You have to go to Joe's office, for example, at the end of the month and find out what he worked on so you can charge those clients, but it's too late to invoice them and the accounting records because everything's been closed. So you make an adjusting entry for that. That would be an example of it. Another example is this. So in this case, you all know that Yahoo is a search engine, right? You all used Yahoo before. Well, they make their money but by providing searches. So when you go to Yahoo and you search for something and you click on it and it takes you to a company, let's say you want to buy something from Walmart and you don't know how to spell Walmart, let's say. Or you don't want to go to walmart.com, you want to go through Yahoo. So you go to your Yahoo or Google search engine and type in Walmart, and it takes you to Walmart. Walmart has to pay for the ability to be for the ability of Yahoo to provide it as a search, to provide it as a search. So Yahoo, Walmart pays Yahoo a certain amount every time somebody goes to Yahoo and types in Walmart. So having said that, so I worked for an internet company called VerticalNet. And we had an agreement with Yahoo that Yahoo was going to put us in the search engine in certain areas. And we would pay an amount based on every hit. Every time somebody typed in VerticalNet and went to our website and did certain other things. But there were other requirements. For example, the person had to stay on the site and click through our other sites. A click through is simply when you, let's say you type in Walmart, and you go to Walmart, and you go to the home site of Walmart, and then you go to the computer department. That's a click through. But there's also click throughs where you may type in Walmart, go to the Walmart page, and there might be a link to a manufacturer on the Walmart page, and you go to that manufacturer. So let's say IBM has a link on the Walmart website. And instead of staying on the Walmart page, you go to the IBM site. That's also called a click-through. Walmart does not have to pay for that because you didn't do anything on the Walmart page. So there's big differences in what you actually pay for and amount and the number of actual, what they call hits you get. A hit is simply you type in Walmart and go to Walmart page. That is a hit, an internet hit. So every time somebody in the universe does that, in the world does that, that is called a hit for Walmart. But that doesn't necessarily mean that Walmart's going to pay for it. It has to meet certain criteria in order for Walmart to pay for it. For example, you have to stay on the website, as this little chart shows. So not only do you have to click through or click on the Walmart webpage, so this is everybody who's gone from Google, from Yahoo and typed in the word Walmart to its in the Google search engine. This million is the number of people who actually stayed on the website. So 4 million people used the search term Walmart for whatever reason, but only 1 million people stayed on the website. Only 800,000 searched on the page of the Walmart. So we have 1 million people typing in Walmart, 4 million people typing in Walmart. We have 1 million people actually going to the website Walmart. We have 800,000 of those people. So we have 4 million people actually typing in Walmart. Of those 4 million people, 1 million actually stayed on the website. Of the 1,800,000 did a search on the website. For example, they went into one of the departments. So 4 million people typed in the search engine Walmart for whatever reason and went someplace else. That either went to the website or went someplace else. Only 1 million of those people actually stayed on the website. went to the website and stayed there. Only 800,000 of those people clicked into a department in Walmart. We also had an allowance of 10%. So the actual hits were 720 that we wouldn't have to pay for. As it says here, we're paying 20 cents a hit, I think, 50 cents a hit. So we're going to owe Yahoo $360,000. However, the only information we get is the 4 million hits. None of this has been confirmed yet. We don't know how many how many search engine hits stayed on the website. We don't know how many total searches went on. And we don't know the estimated percentage of non-hits. The only thing we know at the end of the month is that 4 million people typed in the word Walmart as a search engine property. We have an agreement as part of our agreement with Yahoo, agreed that Yahoo will not send a bill to Internet Company A, and Internet Company A will not make a payment to Yahoo until the correct numbers of hits can be determined for each month. Why is that? Because think about it this way, the efficiency. If I get a bill from Yahoo for 4 million hits, I'm going to multiply that by 50% and send them a check for $2 million. And then once all these other numbers come through, they're going to have to issue me a credit for $640,000. Instead of doing all that and having that mess, we wait until the actual numbers determined, and then Yahoo sends me a bill. However, I did get some revenue from these 4 million hits, or I did incur some expenses for this 4 million hits. Some of these people we know did come to the site, and I'm going to owe Yahoo money for some of those people. So according to the matching principle, again, I have to match the revenues that were generated from the expenses in the period in which they happened. So during this month, I'm estimating that 360,000. It cost me 360,000 for Yahoo to provide me with searches. To make things even worse, we were also providing Yahoo with searches. So people would come to our site and then go back to Yahoo to search something. And we got credit for those searches. Now, obviously, they weren't as many as coming from Yahoo to us, but there were some. And the same thing that was true here is true here. We don't know. We know that 300,000 people used our website and went back to Yahoo, but we don't know any of these other numbers. So we don't know what the final numbers are going to be. And again, instead of us sending an invoice and them having to correct it and correct it and correct it, we just make an estimate of it, of the amount. And then when the real bill comes in, when the real amount's determined, we then pay the real amount. Does that make any sense? How many of you are completely lost? Anybody? Okay, so basically I just explained that to you, but how that works. But basically for this class, you really only have to know that sometimes we don't know the accurate amount, the amount of revenue that was actually the real correct number that was earned in revenue or expenses. So in order to make the period correct, we have to estimate them. And that's really all we're doing here, is estimating the amount of the expenses. As long as you understand that, and that's because of the matching principle, which you have to match revenues with expenses, and also the periodicity principle, which means we have to, that each month, each period is a self-contained unit. We have to get all the expenses for that self-contained unit, that self-contained month in there. Now, if you're an accounting major, you're gonna get deeper into this on Intermediate Accounting 1. But this is all I really need you to understand if you're a business major. The very basics. All right, so I'm gonna stop sharing. Anybody have any questions, comments? You can chat me if you're shy. Joseph, you have any questions? Avery? Emma? Jordan? Jeffrey? Andrew already said it makes sense. Marco, you okay? Travis? I'm talking about, are you okay with everything that we discussed?
Makes sense.
Okay. Everything fairly okay? It'll become a little bit better, clearer when you do the exercise. That's why I have you do the exercise. All right, I'm gonna stop recording. This is recorded, so if you wanna watch it again,